Hello and welcome back. I am Robert, and here I talk about everything automatic algorithmic trading, or simply algo trading. We're looking at my live account on the daily time frame, and we can see the positions I already have on the right hand side. These positions have been interesting in that they have weathered well the market. But the problem with this weathering is they've done so well that volatility has become an issue. The volatility level that we are talking about isn't too much volatility, but actually just the opposite. Too little volatility. As I zoom into the chart and we see what the last several weeks have been like, it's become problematic because, as you've seen from my previous videos, the last couple of months have been very low. Only $4 to $5 of profit, not the standard $20 or $30 to $50. The volatility has dropped so much in the market that the profitability of the gridbot for its current volatility settings is questionable. And that actually hinges on the amount of distance between each of the trades, which right now, as we can see from the chart, is quite significant. This really is where things can get difficult though, because if I lower the spacing between each position I take, I run the risk of ending up with too much volatility that can cause stop losses. If I leave the spacing where it's at, which is the safest approach, then I will simply have to accept low volatility within the market. It's a difficult process that doesn't give any answers. But we can see from the market that we have a few clear indications that volatility might be changing, and it might have a significant impact on future trading. There is a pretty good upward push for high volatility and a pretty good lower push, also high volatility. So even though most of the market has been pretty stagnant for volatility, it's still a dangerous enough region, particularly when we look at the order book in the background and we see this part of the order book well below where I am sitting. Now, since I am shorting the Euro USD, as we look at the chart, that's good. But I also have to consider the upper possibilities of where price might go. And I need to be careful about that in terms of how that's going to be impacted in relation to volatility. For example, if I go to the monthly time frame and we get a bigger picture, we can see that at one point I had less volatility position sizing and it caused a problem. This would have automatically caused a cascade of stop losses had my program not adjusted the volatility based upon the market. And now that the market has gone back to low volatility, and I have quite a few trades in place. For example, right now, I am sitting at roughly 55, 56 trades of my 73 trade limit. That's quite a bit in terms of the total number of allotted trades I allow this process to have. It's only 16% of my margin, but it's still something I need to be aware of as I continue to watch where the market is going. It's all too easy to lower the volatility to get back into the lower ranges, like what you see at the bottom of my chart, where trading did excessively well. I pulled in as much as $50 a month with the lower volatility levels. But the risk of the upward push that we see on the chart was so significant that I backed off concerned that I would blow my account. And this is a real situation that goes on daily in trading. It's wonderful when the market works in your favor, as we can see by the highlighted section with the 3 months of downward pressure that I was able to capitalize on and completely clean off all of my open trades before starting a new cycle around early April, mid-April. But when the volatility goes against you, starting around late April, as we see on the chart, 5 months of straight upward pressure. That's a lot of volatility and a concern when you're dealing with a very specific kind of trading approach that requires you to hold your positions. So this is a real difficult area to be in, and something that you're going to face quite aggressively, because you don't know where or when that volatility is going to make a showing. If we go back further on the chart, we can see we had quite a few months where the market was in a pretty reasonably stable range, and that range was quite nice for trading. Perfect for small or little volatility movement positions. But that problem that we've discussed, when volatility actually takes off, is a problem that can never be predicted. If we go back a little further in the chart, we can see that this particular part of the chart had a lot of downward movement. This was a nice place to be on the chart, but it went in my favor. This could have very easily have gone against me if I was trading in a long position, and then I would have burned my account aggressively had I had the limited volatility range. But this is the kind of problem that requires a lot of careful consideration, because once you have as many positions as you have open as I do, it's difficult to change volatility or certain metrics that affect the overall grid just because you can't readjust the positions you already have open. Only future positions that exist in the market. And that's probable because you have less resources to work with, so you have to take into account your existing resources and where they are placed, where the positions actually rest on the chart. This kind of a paradox is what destroys traders. If you're not aggressive enough or too defensive, as this grid has become, then your profitability is going to be lower than what you would want. But if you're too aggressive and get too aggressive, then the market is going to take advantage of you and wipe you out. There is no real right or wrong to this question, at least not on the technical side of it. Every trader has to evaluate their risks, and this kind of a risk is a common occurrence. Do I become more aggressive, or do I stay where I'm at and simply wait it out? It's a difficult decision, and one that I really don't have an answer to yet, because we can see by looking at the history that we have several cases where volatility has had huge impacts in the market. And in the particular case on the chart right now, which is 2016 to 2017, this particular volatility run would have destroyed my account. And we can still see at the very top of the order book, there are still people with positions sitting here, whether they are waiting for it to return to that pricing or whether they are looking to profit at that price. we have a situation clear and well defined on the basis of the volatility within the market. Overall, my gut feeling is to say leave it alone, because every time I've messed with something that's been working, I've ended up destroying my profits. So my overall assessment is leave it be and let it do its job. The gridbot was never meant to be an aggressive process, only a passive process. So it's a situation where I may need to refactor in the long term and figure out some kind of a short term. I don't know yet, to be honest. So Euro USD is in a difficult spot. But this past week, with economic data from Mexico, Canada, the United States, France, and Germany signaling downward pressure, it might be in my favor just to sit still. Now let's go to my other pair, the pound Australian dollar. This has been a quiet pair, but not something I'm going to make a lot of money on. Right now I've got about $1 sitting on the table, and as we can see where I've got my take profits set, the green lines, I am simply waiting this one out. The market is reversing in my direction, but I've sat here now for about 10 months on this position. For what I'm going to get for a profit, this is not worth it. It's not worth the amount that I'm going to make in profit. For the standpoint of the volatility, this is probably one of the worst trading pairs I've ever done. From the standpoint of the experience of learning the lazy trading technique, it's one of the best pairs I've ever done because it has such low volatility that I have plenty of time to react to the market. That being said, I recommend this pair if you're just learning and you need something slow to give you time to look at the market and evaluate your direction. If you're looking to algorithmically trade this pair, I do not recommend it. The liquidity and volume is just not there. So let's go and look at the activity itself. And you can see that most of my activity is quite slow in profits. There's some here and there, but overall it's been very quiet. Negative interest has been just as profitable as the positions themselves, which is a good thing, and that works in my favor for this particular grid bot. Had I been trading a pair where I would be getting charged this finance rates, then I would really have to think about the direction of my trading, because the finance rates would easily eat my monthly profit. So that is a consideration for this kind of a passive technique. You need to make sure you're always making more than you're paying, or you're going to just lose money for nothing. But let me know what you think. How has the market been for you? How has your trading been with the current volatility in the market? Have you done well and made profits, or has the volatility gone against you quite aggressively? Share your thoughts and leave a comment below. If you liked this video, please give it a thumbs up. If you're not subscribed, please subscribe. And if you're interested in more content, be sure to check out my sentiment analysis for the coming week. It's on my Patreon, and it covers quite a bit of what I've already talked about in terms of the economic situations for Germany, France, Canada, Mexico, and the United States. It's quite extensive, along with several other different articles that I post quite aggressively and frequently talking about different financial situations. The link will be in the description. Thank you for watching.